back now, but we're joined by this man, Chris, and let me explain. Chris, how are you, my friend?
I'm doing much better today, gentlemen. How are you?
Are you feeling good? Good, I'm glad.
All right, Mr.
Nothing
Vecchio.
like heading to a toddler birthday party over the weekend and being intermingled among dozens of kids. Little germ factories.
Hey, we've all been there. Now I'm around dozens of adults that are all germ factories. It's okay, same thing. All right, I'll let you lead. Let's do it.
We've seen another tick higher in U.S. bond yields here in recent days. I think really this is for reasons twofold. First off, the Fed continues to plow forward by suggesting that we will see another rate hike this year and perhaps two fewer cuts for next year. The market ahead of last Wednesday's Fed meeting was pricing in 4 rate cuts for 2024. So that does pull up bond yields at the front end of the curve, particularly in the belly of the curve. But the big mover and shaker in markets has been what's been happening at the long end. ZB and UB have been the focal point of attention here in recent days. Last Thursday, it was a complete meltdown at the long end of the curve. And I think that's because we're also seeing the Fed's long-term estimates of where their interest rates are heading. They've actually moved up. So for all this macroeconomic, dare I say, nerdy talk about what the R star is, the neutral rate of growth over the long period of time, we see now that the Fed is suggesting that interest rates will not be going back down towards that zero lower bound anytime soon. And so that naturally raises the question, why do traders dislike rising bond yields, and why does that cause them to sell down their stocks? Well, first things first, in the post-World War II era, stocks have actually outpaced their bond counterparts. Stocks have returned about 11% per year, whereas bonds are closer to a 6% return. Okay, but we have to take volatility into account, of course, and one way that we measure that is the standard deviation of returns. And sure enough, we see that stocks have about a 13% standard deviation during that time, whereas bonds have, roughly speaking, an 8% standard deviation. So it comes into the question now, which one offers better risk-adjusted returns? One such way that people strip this away is by looking at what's known as the Fed model. It's popularized by Ed Yardeni. You probably see him on Bloomberg or CNBC from time to time. But the basic idea is that you compare the earnings yield of the S&P 500 to the yield of the U.S. 10-year. Now, why do we bring this up? Because that gap is narrowing. In fact, the difference between the earnings yield on the S&P 500 and the Treasury 10-year yield is now at its lowest level since 2001. So on a relative basis, stocks are losing their appeal relative to bonds. And there's also some arithmetic here, guys, which I know you guys prefer. This all goes back to the discounted cash flow model, DCF model, which is the present value of current cash flows is basically all future cash flows divided by an interest rate depending upon the period of time. So for next year, we take next year's cash flows or projected cash flows, then we divide that by 1 plus next year's interest rate. So as interest rates are going up, the denominator is rising, the future value of all cash flows is falling. All of a sudden, the present value of cash flows is lower. We have to take down our equity valuations of PEG. So it's a problem across the board. Earnings yields are falling. Cash flows estimates are falling. We're now seeing that the denominator interest rates are rising. The market's telling us that longer term interest rates are going up. And on a relative basis, equities have not been this appealing relative to bonds since 2001. I would ask you guys then, do you find the rise in bond yields impacting your decisions with respect to how you're trading the stock market?
Well, I have a couple things. So specifically to answer your last question, bond yields don't impact how we trade the stock market because traders are in search of opportunity, and opportunity comes with a little bit of, confusion or fear. Confusion and fear have this inverse relationship with opportunity. So traders, when you use the term traders, no, we couldn't care less. Whatever creates fear, creates opportunity is good for us. So that's that part of it. But I think if you're talking about investors in general, and not traders, of course, when you get higher interest rates, you're going to have to take a step back because the relationship between risk-free rates and whatever else it is that you're doing, that as that relationship shifts, it obviously shifts the mentality of or it will change your thinking as to how much risk you want to take in the equity marketplace. If you can generate a risk-free return at, let's just say, if it gets to 6%, just as an example, if you can generate risk-free returns at 6%, then investing in the stock market, for a 10% potential 10% passive outcome,
because you're using that as an average, 10%.
yeah, well, that's the number that Chris threw out.
Yeah.
If you're using that 10% number as a passive average, then it becomes significantly less attractive than if interest rates are 1% and you are
guaranteed 1%, 2%,
and you're looking at a 10% payout. If you're giving me 10 to 1, I'm going to invest in stocks. If you're giving me, less than 2 to 1, I'm going to think twice about investing in stocks. So I think the answer there is it's pretty obvious. Of course, it's going to impact people's decisions to buy stocks. It has to. It's simple. That is just math. But I think from a trader perspective, no, it doesn't impact us, because traders want high implied volatility. They don't care what generates it, and so we don't look at interest rates. The only thing that a self-directed trader would look at is, at Tasty, we talk about, in your head having some multiple of risk-free rates, which is what your target is. So if risk-free rates are 3%, then your target might be 5 times risk-free rates. So maybe you're going for 15 or 20% as an active investor. If risk-free rates are 6%, then markets become less stable, more bouncy, but then you're only going for 3 times, to get that same return. So it's a little more attractive. So I guess my point is, the active trader side, no, we never change regardless of rates. The passive side, yeah, it's a huge influence.
I think for my decision making, it leads me to believe that you're probably looking at a period where equity markets have a little bit of a drag on them. And so when I'm looking for directional trading opportunities, it becomes that much more difficult to justify taking directional shots on the long side. But you mentioned the fear component, the volatility component here. And this is kind of the rabbit hole that I'm going down now. I couldn't help but notice that the IV index on GCZ3, the December's expiry for gold futures, was lower than what we're seeing in many parts of the bond curve. So I went back and pulled up some historical data, and sure enough, this is really the first time in history, going back to the early 1970s, after Nixon unpegged the dollar from gold prices, or unpegged gold rather, we see that gold vol is persistently lower than bond prices here. And so when we talk about opportunity in the market right now, bonds perhaps are offering a unique set of circumstances where they become a little bit more tradable, a little bit more appealing to swing in and out of on a daily or weekly basis, given the fact that this market has become unglued. The MOVE index is a little bit of a, we'll call it, I'll say it's papering over the concerns here. MOVE index, which is the Bank of America ICE bond volatility index, is not at significantly high levels. It's basically been bouncing around in a range here for the past few months. Well, and while it's elevated here in recent days, it still hasn't broken through to, say, yearly highs. But bonds are now exhibiting a characteristic that shows that they are more unstable than perhaps they've been for a very, very long time, particularly compared to other asset classes.
Yeah, and I mean, I do think that gold, the implied volatility in gold is interesting, although I think gold is, gold is a dead asset. At least it has been in 2023. So I don't think I don't think it carries any relevance at this point, as far as volatility goes. And I think that the discussion about, directional, I think one of the things, Chris, that's old school, you think sometimes a little more, you think differently than we do. And in a certain way, you're definitely younger than us, but sometimes you think older, because you have we have the mentality where direction to us is less important to an active trader than it,
Sure.
25 years ago, direction, I guess, was really important, maybe 20 years ago. But I think the game with strategic investing, I think the game has changed a lot, at least at Tasty. So I don't think direction, like, although we love to be directional, like I bought some, I bought some Delta in IBM this morning. I bought some Delta in Alcoa this morning. We definitely make directional plays, but the strategy is more important to us than the direction. So I think given the markets that we have in 2023, there's so many more ways, to skin the cat type of thing, that I think it's just different. And I think that we're much more focused on strategy than we are direction. So direction to me doesn't matter as much. That's why the bonds, bonds, gold, whatever else it is. Gold's only relevant now if it comes back into play. Same thing with silver, same thing with anything. When things fall out of favor and they're just not in play, man, they're really hard in this era to get anybody excited about. This is an era that everything flows towards the noise.
I want to address that point that you're bringing up here, which is sometimes I feel like traders, when they place trades, it's because they want to prove that they're smarter than everyone else, right? They're placing directional bets because, like Michael Burry in The Big Short, they've identified a mispricing in the market that they can only see, and therefore they're smarter than the collective rest of us. Our job as traders, and you speak to the strategy point of view, our job as traders is to read the tea leaves, to look at the set of data, the charts in front of us, the options prices that we see on our screen, and using our historical knowledge of what's happened in similar types of markets, place those probabilistic bets. Right? We're not trying to predict the future. We're trying to identify the market conditions and pick the tool out of our toolbox, the strategy that's most applicable, that's been most successful in those type of similar environments. You don't need to be a hero here. No one's going to pat you on the back at the end of the day because you identified that singular thing that no one else saw. People pat you on the back. You pat yourself on the back, more importantly, when you are able to identify the situation properly and execute the trading strategy that yields the most profitable return for the capital that you have laid out on the line, plain and simple.
Yeah, that's pretty fair. We're a little bit more. We've taken to heart a little bit more so the trade small, trade often. Like, we're much more like strategically diversified than we are anything else. But yeah, that's generally speaking, that's correct.
I suppose the last thing that's worth discussing here today, this impact of a potential U.S. government shutdown. For those that have been following the Kabuki Theater in Washington, D.C., it appears increasingly likely that we're heading towards a shutdown at the end of this week. And so I suppose the question is, how bad will this be for markets? Probably nothing at all. I say it's going to be probably nothing at all because the data simply suggests that markets don't really care about government shutdowns. If we go back over the past 40 years, the average government shutdown has lasted 9.5 days. The S&P 500's average return during government shutdowns has been 0.3%. The median return has been 0.3%. Perhaps you can make the argument that this time will be different because of the composition of Congress. We'll see several starts and stops here over the next few months. More than one government shutdown is certainly possible. But the fact of the matter is that government shutdowns really do not matter for equity markets. And quite frankly, it might be welcome this time because we do have this concern that the government has been spending a lot of money. Deficits, of course, are growth positive. G as a positive coefficient in our GDP equation, after all. And so if people are concerned that the Fed sees a market that, or at least an economy that's been stronger than they anticipated, which necessitates more rate hikes, well, then anything that spurs lower growth could perhaps take some of the pressure off of that, at least need for more rate hikes in the short term. So I would argue a government shutdown coming up, growth negative, but markets neutral, if not slightly positive.
Yeah, I mean, I think that's a great summary. For us, Tony and I would say, first of all, the chances of a government shutdown are really slim, and they always push it to the last possible minute.
12th hour, yeah.
Yeah, they push it to 12th hour, and even if the government shuts down, I would look at that as an opportunity, not as. I mean, the government's not staying shut down. Like, there's certain things. We can sit here and we can argue about reversion to the mean. We can sit here and argue about lots of different things in trading. But one thing is a fact. The government's not shutting down. Like whether it's we go to the 12th hour or whether we go to, a week, or what'd you say, 9 days was the average shutdown?
About 9.5, yeah.
9.5 days. Okay, whether we go to 9.5 days or whatever it is, the government's not staying shut down very long. And so they will reach an agreement, and then when they reach, blah, blah, blah. So I consider this to be, I agree with the non-factor. If anything, it'll turn out to be a short-term low or or an opportunity in some way. Personally, I couldn't care less. Like I don't think they'll shut down, but I personally couldn't care less. I think it's bad, I think for politicians, it's obviously bad. Like nobody wins because everybody's already so sick of, Washington, and so sick of all the political bullshit in this country and sick of all the divisions in this country because of all the politics. I don't think that there's anybody that really cares, enough to other than it's just going to create, more animosity, more hatred, more doubt about what goes on in Washington. So I just don't see any upside for them. I don't think the general public cares. I mean, obviously, if you work for the government, you care because you don't want a disruption in your life. But I just don't think that, the consumer in America really gives a crap whatsoever. And I think they just look at it as another kind of like, this is embarrassing, so just get it done. Stop your bitching, just get it done.
So if only to close out on that point here, perhaps one of the tail risks that we need to consider from a government shutdown is a U.S. debt downgrade. We heard from Moody's warning that we could potentially see something negative related to our credit situation here in the United States if there's a government shutdown. It's not like 2011 or even earlier this year when we were hurtling towards a default. But in situations where government shutdowns or potentially government events lead to concerns over the credit rating, it's worth reminding people those tend to be environments where not only do the US dollar and the Japanese yen do well, but bonds and gold both tend to outperform stocks. So something to keep in mind here if we start to see headlines about another US credit rating downgrade, the bond market, despite all of its problems here in the past week, might become a little bit more attractive, as perplexing and counterintuitive as that sounds. I
actually think that I think the bond market's going to become more attractive just for lots of reasons. First, it's oversold. Second, just like what you said, we haven't seen a flight to quality in quite some time. But I think there's also another important thing that we're kind of glossing over, which is that the move in the bonds has been pretty relentless. And I don't think there's a lot of people that saw bonds getting back down to 115 regardless. And so I think that there's a story in the bond market, in the move in the bond market, which I don't think you can discount at all with respect to the stock market, which means this could get a lot uglier in stocks before it gets prettier. And I don't think you can discount that. So I think that is the bigger story out there right now, is that if the stock market looks at the bond market, the stock market could be 4,200 before you blink, because that's essentially what happened to the bond. I think there's still a lot of bond traders that are going out there. I can't believe we broke 120. Or I can't believe we broke 118. I can't believe we broke 116. And so I think there's a lot of people in the stock market that are saying, this 4330 number is really good. But what if we break it? And what if we go, what if the same thing happens in the stock market that happened to the bond market and we get down to 4,200 before you blink? I could easily see that happening. And I think that, I shouldn't say easily, but I can see that happening. And I think that's the real risk. It's not the other stuff. I think it's the stock market get uglier than people think. I hope it doesn't happen, but I think it's a real risk.
Very good.
I agree.
He's Chris Vecchio. I'm Tom Sosnoff, Tony Batista here in Chicago. And thank you, Chris. Good stuff today. And anybody that wants to catch Chris will be on, what are your times today on the network?
Futures Power Hour, 1 p.m. Eastern, 12 Central Time, every Monday to Friday. And then overtime, 4:30 Eastern, 3:30 Central with Ilya Spivak and Dylan Radigan.
Who are you on with the Futures Power Hour today?
Jamal Chandler.
Oh, little Jamal. Beautiful.
Take a quick 90 seconds.
Nice.
Go ahead. What did you want to say?
I just want to remind him that I did beat him in the Tasty Live fantasy football pool this week, so it's going to be a fun show.
Oh, I'm sure you should rmind him many times. I mean, he thinks he's, star athlete, ex-star athlete, like he's a very cocky, Wisconsin grad. So he's got a Big Ten, what do you call that? Like a Big Ten head.
Swagger.
Yeah, Big Ten swagger. Yeah. Yeah, it's okay. You can shut him down.
As you can, all Big Ten schools. We'll take a quick 90-second break and come back. We got more Tasty Live after this with market measure.